I get asked to create a video on this topic more than I get asked to create any other video. My name is Shane Fleming and this video is a market update and outlook video. I will quickly summarize the commercial and residential markets and review some of the data that's out there, as well as providing an outlook for each sector. If you have any comments or any thoughts in regards to this topic, please put your comments in below. I'd love to hear from you. I will touch on some of the trending topics, including inflation, look at some of the figures and data. Mainly the figures and data that I will be using without this video will relate to Ireland, but the outlook will be a global outlook and will be applicable to any city. Generally speaking, these videos in terms of market updates and outlook videos take me a while to put together, so I would love to have some of your support. Give this video a like, also subscribe to the channel if you haven't done so already. It means a lot to me and it keeps me motivated to keep creating more videos. So let's get commercial out of the way, because I know most of you are here to hear about the residential market, but it's important to understand where the commercial market is because it will impact the residential market as well. Bad news first, retail. Retail has continued to underperform, which is hardly surprising given the trend for online shopping and also all the lockdowns. High street retail has probably fallen in value by about 5% this year. That, coupled with last year's fall of about 26% in high street retail, is an estimated 30% fall in the last 2 years. It's not all bad news. Vacancy rates in high street retail has started to level off, and some positive news in terms of retail. Out of town or bulky good retail have continued to perform reasonably well, and vacancy rates haven't been too bad. The office market did show signs of falling value in the last 2 years. However, prime office space has maintained reasonably strong values and has only fallen by a few percent. There are slight indications that value in prime office locations are improving, and what might surprise people is that vacancy levels are actually really low. This has partly to do with slowdown in construction, but a huge amount of companies and businesses are continuing to lease space regardless of the fact that work from home. I think a lot of businesses are on the assumption that they will continue to need office spaces, and there is a demand for office spaces within prime locations at the moment, and vacancy levels are quite low. However, as businesses start to rethink their office space going into the future, perhaps we may see an increase in sublets available going forward. Industrial has outperformed every sector. I've said this before over the last 2 years. I've said it a number of times that industrial was the space to watch and the space to go after. I actually was thinking about cutting in a video right now from about 2 years ago or 18 months ago where I had said that retail was going to suffer massively and industrial was the one to watch and the one to go after. However, when I saw that video and I saw how I performed on camera, I really didn't want to cut it in here. Not that I've improved all that much, but I was absolutely terrible back then and I don't want to put it out there now. So if you want to see it, it's there on my channel back about 18 months ago or 2 years ago when I had said that industrial was the one to watch and the one to go after. But as predicted, industrial values have increased dramatically. In the last year alone, they've increased by 20%. Vacancy levels are at an all-time low and values are therefore skyrocketing. This is due to two main key factors. One, retail is obviously moving online and industrial is benefiting from that. The other key factor is very little industrial units were constructed between 2007 and 2017. So therefore there's a huge lack of supply out there in the current market. Industrial units are now showing a better yield or a better cap rate than retail for the first time that I can remember, or perhaps for the first time in history. A new entry in recent years in the commercial sector is the build to rent or the serviced apartments, which actually surpassed and outperformed the office market in terms of value in 2020. A lot of real estate professionals in Ireland believe that the build to rent market actually performed incredibly well in 2020 and outperformed the office market for one key factor, and that was because investors could buy off the plan and didn't necessarily have to travel to Ireland, where office investors would have liked to travel to Ireland and see the product and therefore held off investing in 2020. So let's touch on the residential market now and then go back to the outlook. So according to the CSO, residential houses and apartments increased by 10.9% nationally in the year to August, and also Dublin residential house prices increased by 10.2% from the year to August, while properties outside of Dublin increased by 11.5%. Overall, the national index is 8.9% below its high in 2007. The total price increase for residential stock in Ireland for the year from January 2021 to August 2021 is 8.3%. Sadly and very disappointing, stock levels have not increased dramatically at all. Sadly, they're actually well below average. Nationally, we have about 11,000 units on the market at the moment. Ideally, you'd want about 17 to 19,000, maybe even 20,000. In Dublin alone, there's only 3,200 units. Ideally, you'd want about 5,000. So again, this is very damaging in terms of stock levels, and it doesn't look like it's improving anytime soon. I recently let an apartment in Monkstown, a 2-bed, and within 48 hours of putting that apartment online, I had 157 inquiries. Sadly to say, I actually think the rental crisis is far worse than the home buying crisis, and I can see now that the government have introduced a maximum cap on rental increases of 2%, regardless of what inflation is. I can see that this is going to lead to more and more landlords exiting the market and making it even harder or making the rental crisis even worse. And I think it's one thing that nearly every economist agrees on is rental caps don't work. They do a number of things. What they do is they push landlords out of the market, leading to less rental stock. They de-incentivize development because it means that less people want to get involved in the market. And it also means that existing landlords who are there will not put massive amounts of money into improving their property because they know they won't get any return on that. So therefore, it only benefits a handful of very lucky people who actually get to rent those properties, and it basically makes it very difficult for anyone who's trying to enter that market. And it's been proven for the last 100 years from cities from all over the world that rental caps just do not work. The rental crisis is arguably worse than the home buying crisis, and I don't see that it's going to get any better until people get their heads around to the fact that build to rent schemes actually benefit the overall housing market. So let's move on to the outlook and explore what might actually happen to property prices going forward. When you are looking at property prices, it's important to look at 4 key economic factors. Those economic factors include GDP, inflation, employment, and interest rates. Generally speaking, there are 1 or 2 other economic factors that come into play as well in terms of population growth, government policy, as well as build and construction costs. But it's also important to remember that supply and demand are not economic factors, they're just the consequences of these economic factors playing out. So when you look at GDP, in Ireland, we're currently looking at a record level rates in 2020 of 15 to 16%. However, when you strip out the impact from some of the multinationals, you're probably more looking at a GDP of around 5.2%, still very high. Employment is improving. Granted, some sectors have been very hit in terms of hospitality, but the tech sector continues to grow, and there was a 20% increase in employment within the tech sector, which means good, strong, high-income jobs are growing and going the right direction. Over the last few years, we've had low inflation, but if you're looking at inflation now, it's starting to creep up to about 2% in 2021. Granted, some areas of the economy costs have gone up way more than that, but that is what we're looking at from a statistic point of view. Increases in GDP, employment, and inflation generally all point to higher property prices. There are some people out there that have a view that inflation is actually negative towards house prices. Well, what actually happens if inflation goes up, it means prices go up, and it also means house prices go up. It generally means, in terms of high inflation, what happens as well when people have cash in the bank, they decide to put them into assets in terms of stocks and shares and gold. And a lot of people look to put them into property as well, therefore increasing more demand on property, further pushing up prices. But there is an inflationary risk, and that inflationary risk is if the central bank deem that inflation is running too high, they will increase in interest rates in terms to try bring down the amount of capital that's in the market, therefore bringing down demand. However, if we look at inflation running at 2%, what is the risk of the European Central Bank actually increasing interest rates if it's running at 2%? The European Central Bank is targeted to keep inflation below 2%. However, that is over the medium term, so over a course of 2 or 3 years. If we look at the central banks, the European Central Bank's forecast for the next few years, in 2021, they're forecasting 2.2%. In 2022, they're forecasting 1.7%, and in 2023, they're forecasting 1.5%. So this is below their 2% target over the medium term. Therefore, in their eyes, they don't see inflation as a major risk. You can correct me if you want in the comments below in regards to inflation, or share your views in regards to inflation. I know a lot of people would see that inflation is running very high in some particular sectors, but right now, in terms of the figures that are out there from the European Central Bank and how they're tracking inflation, it would seem that they're tracking it below their 2% target. I'm not saying inflation is not a risk, it definitely is a risk, and there is a risk that the European Central Bank could increase interest rates. However, right now a lot of people within those kind of faculties believe that a huge amount of the inflation is related to supply chain issues, and that should dissipate or kind of balance itself out over the next year or so. However, even if there was high inflation and interest rates were to go up, there are record levels of savings and cash on deposit within Irish banks, a record level of 139 billion. This is enough to buy the average amount of properties that are sold on the Irish market for 7 years without ever having to go to get a mortgage out. Talking about mortgages, it's estimated that another billion will be added to value of mortgages next year in 2022, a further 2 billion in 2023. This will bring the total mortgage value market up to 14.2 billion. There is a school of thought out there that a lot of young people will leave Ireland because of the housing crisis, and this will ease demand slightly. But I find this very hard to believe, because if you look at all the major cities around the world, they're all suffering from the same thing, and many of them are actually suffering even worse than Ireland in terms of price increases and rent increases. And I don't see that there will be a huge amount of people leaving Ireland for better jobs elsewhere, because there's actually more jobs probably available in Ireland. Also, getting visas for some countries like US is getting incredibly difficult and harder for people. So I don't think there's going to be a mad rush to actually leave Ireland. I actually think more people will come into Ireland, and there will be a continued population growth, therefore increasing demand even further. It's also likely that construction prices will continue to rise, and therefore there's a lot of factors out there that would all point to continued house prices going up over the next year or two. I don't want to be the agent that puts out a video that says, oh, prices are definitely going to increase, and be criticized that I'm just an agent. I have put out videos where I've said certain sectors will decrease. I do a lot of acquisition work, so it's not massively in my benefit if the property prices continue to rise. But unless there's some sort of global shock, I do not see house prices decreasing massively in the near future. And all those people who are hoping for a property crash, I really don't like the idea of what it actually brings with it in terms of negative equity, arrears, unemployment, and the likelihood is people will find it far harder to get a mortgage as well. I do predict that some markets that were overheated due to the work from home craze will slightly start to slow down, and perhaps there might be some slight decreases in value there. It was predicted at the start of the year that house prices would increase by 13%. I kind of said at the same time that we're probably tracking around 10%. Looking at it now, we're probably somewhere in between 10 and 13%. In terms of commercial, office will likely stay steady. Industrial will probably continue to grow. Retail probably will fall even further. However, there is some signs or some green shoots there. Looking at other cities that opened up before kind of Ireland and Dublin did, there is definitely letting opportunities happening. A lot of that is happening in the food sector and the beverage sector in terms of bars and restaurants. There are some weed operators or weed orientated operators that are looking for spaces in major cities as rules and regulations change around that dynamic. Also, there are more and more discounted pharmacies opening up, but I think a huge amount of the retail will stay vacant until rents come down and make it more feasible for operators to come in. I think if rents do come down, there will be opportunities for online retailers who established themselves over the last few years to actually take a presence on the high street. The main risk to the market at the moment is probably interest rates if they were to increase. Obviously, we could have further lockdowns or further setbacks from the virus, which would have impacts on different sectors of the economy and different sectors of the property market. Also, perhaps something could happen on a global level that could impact local markets. The risk from an Irish or domestic level would probably stem from policy changes or government changes that could impact the level of investment coming into Ireland, which could impact the level of development or impact the number of jobs. I hope you liked that market update and outlook video. Add your comments below, share your thoughts, make sure you give this video a like. If you haven't subscribed to the channel, please subscribe to the channel as well.